Hello, everyone, and thanks for joining me. Today, I'm going to cover Suncor, the recent investor information Q3 2024, which was published in December 12th, 2024, as you can see here. And what actually happened, I'm recording this in the beginning of January, and Suncor had quite a run the last couple of days. So what's been happening essentially is that they came out with the news that their production uplift is much more bullish from what was initially expected. And so market cap right now is about 66.2 or so billion dollars, and stock ran up to $55. So just today it was up 4%. So I'm gonna basically cover the slides on where the company stands, cover what the news was all about, and just kind of go from there. So yeah, we're going to talk about the economics, the assets, stuff like this, and I'm going to provide kind of my own, I guess, interpretation of what I'm seeing. But in overall, I think it's really important to consider that this is by no means any financial advice. I'm not a financial advisor. I'm just looking at publicly available data and studying this data and sharing with the community. So that's kind of where I'm at with this entire concept of liability, I guess. So in their slides, Suncor, they communicate that their value proposition is really in their long life assets, competitively advantaged assets. So they have mining assets, they have in situ assets, so the assets that they do thermal recovery schemes essentially, and regional vertical integration. So obviously they're showing here a gas station, so they have a gas station business and refining business, right? So they have operational reliability here. They show something that's really important, I guess, for them to share, and disciplined investment and cost management. But this regional and vertical integration, I guess, is kind of they basically produce the products upstream, and then they have this downstream business that's been integrated. So they deliver superior long-term shareholder value. That's what they communicate. So let's look at some of the stats now on where the company currently stands. So market capitalization is 63 billion. So this is in Canadian dollars. What I communicated just now is that as of today, it's 66 billion, 66.2. So there was an appreciation of about $3 billion in their market cap since basically this presentation that they made a month ago. So quite a 5% move or so in the market cap. Their net debt to AFFO, so AFFO stands for adjusted funds from operations, it's about 0.6. And below here, you can see that AFFO Q3 year to date is about $10 billion. And so if you take that 0.6, you can see the debt is about 6 billion. Oil sands reserve life index for 2023 was 26 years. Upgrading capacity. So when we talk about them upgrading oil, they basically upgrade 556,000 barrels per day, and refining capacity is 466. So they upgrade products and they refine products. Production to market as of Q3 year to date is about 812,000 barrels per day. And let's kind of stop here for a second, and I'll provide you with the update on what was actually shared in the news release and why the stock moved up 5% in just 30 days or so. So as you can see here, production to market Q3 is 812. In their news release that was shared on January 6, 2025, so just a day ago, they provided an operational performance update for the upstream and downstream businesses for the fourth quarter and the full year of 2024. So the upstream highlight is that in the quarter, in Q4, they achieved quarterly production of 874,000 barrels per day. So that number is up 66,000 barrels per day from Q4 and Q 2023. Now, when we look at basically the slide and we're looking at A12, as I highlighted there, Now, big difference. We're going to 874,000 barrels per day. And that's why I think the stock moved significantly, and market kind of participants got excited about the news. Maybe the news release was kind of a function of that, to say, hey, we're kind of overachieving here, and kind of create this momentum towards the earnings, I guess. Now, quarterly upgrading utilization is over 100%, so it's 103,000 barrels a day, with syncrude and base plant greater than 100%, basically. So the record annual production is 827. So if we take this number of 812 that you can see on the slide, and we kind of integrate that 874,000 for Q4, the average basically production for the year is 827,000 barrels per day. So it's up 81,000 barrels per day, or about 11% from 2023. So since Rich Kruger took over, you can see kind of this progress towards more reliable delivery of hydrocarbons to markets. Annual production, 17,000 barrels a day, above the high end of guidance. So when they guided below. So obviously they guided 810,000 or so. So now 827 is the official number. And again, I think, some companies do it extremely well. Some management teams do it extremely well. They under-promise and over-deliver, and so that's kind of what we see in this case. Record annual upgrader utilization of 98%, so 6% higher than previous best, and record annual utilization of 99% and 96% at base plant and syncrude respectively. So base plant did 99% utilization for upgrader, and base plant and syncrude did 96%. They also have record quarterly and annual production of Firebag, and so this is something I shared online in the past, where they achieved over 250,000 barrels a day in one of the months this quarter at Firebag, and the annual production at Firebag was 234,000 barrels per day. And for those of you that don't know the difference between mining, which is fairly straightforward to understand, basically they use kind of like a shovel technique, right? So they mine the material, they move it in trucks, and they have a basically processing plant where they basically refine that crude, separate. Obviously, they use a lot of water to separate the crude from sand, and from kind of embedded clays, I guess, and water, whatever is all that mix in there, and utilize that in mining, right? So in mining, they basically mine the material. Where right now we're talking about Firebag, the 250,000 barrels per day that was produced in the quarterly, it's more steam-assisted gravity drainage. So they inject steam underground to reduce the viscosity of the oil, so it can be drained by gravity. So they, for the year, produced 234,000 barrels a day, and for the quarter, 250. Sorry for getting a little repetitive there. For annual production for Fort Hills, so obviously lots of news Fort Hills this year, 268,000 barrels per day, including the plan above plan production of 161,000 barrels per day in Q4. Downstream, now we're talking basically refining. So everything we talk now is about where did the 874,000 barrels per day on quarterly production come from, and where the Q4 production come from. So this is everything I just covered. Now let's talk about the downstream part. The quarterly refining throughput was 487,000 barrels per day. In my slides here, you can see that, in the Suncor slides, you can see upgrading capacity 556 and refining capacity 466. So in this update, they basically said, hey, we actually refined throughput 487. So they basically overachieved even there on the quarterly basis. So they tied with Q3 quarter 2024, which is up 31,000 barrels per day from Q4 2023. Quarterly refining utilization was 104%, with all four refineries greater than 100%. Record annual refining throughput 465,000, up 44,000, or 10.5%. And so now we can start seeing the increased production by over 10%, but they also improved their versus 2023, but they also improved basically their refining throughput by 10.5% from 2023. Annual throughput, 20,000 barrels per day above the high-end guidance. Again, under-promising, over-delivering. Annual refining utilization of 100%, 5% higher than previous best. Record annual utilization of 105% and 98% for Edmonton and Montreal, respectively. And record annual refined product sales of 599,000 barrels per day and 46,000, so or 8.3% from 2023. So we see a lot of improvements from 2023, close to that 10% mark. And yeah, like quite remarkable, right? In the statement, Rich Kruger said that Suncor's exceptionally strong operational performance in both Q4 and full year of 2024 across all our businesses was supported by an ongoing focus on fundamentals, including safety and operational reliability. One thing you gotta, respect with Suncor is that they did improve their safety tremendously, and obviously operational reliability. We can see in numbers that they improved by 10% on upstream production, including mining, and downstream close to that number as well. Their strong operational performance also supported strong financial performance, including enabling us to achieve our 8 billion net debt target 9 months ahead of the projected outlined in our May 2024 3-year plan. So basically, they're overachieving on reducing their debt. We're committed to maintaining this level of focus and results orientation to continue delivering value for our shareholders in 2025 and beyond. So that was kind of the statement. Hopefully kind of gives a little bit of kind of insights to why they saw such nice kind of boost in their stock price. And that speaks to the numbers from a month ago that kind of covered the annual performance for the year, as you can see in the slides here in the slide, but they overachieved clearly as indicated. So when we talk about production to market 812, obviously Q4 was amazing. So Q4, they produced 874. So big uplift from the number that you can see here. And the refining utilization, 98%. Obviously, that number went higher. The AFFO, so adjusted funds from operations, 10.4 billion. Capital expenditures, 4.7 billion. So you can see here basically Q3 year to date. And FFF, I think it stands for free funds flow, so free cash flow. Q3 year to date, 5.4 billion. So now you're looking at basically market cap plus debt, right? So, and you look at this and you kind of very quickly end up at about 10% free cash flow yield, maybe more. So in these slides, they talk about strong cash returns and resilient balance sheet. I mean, obviously, companies are doing a good job to kind of communicate that their performance. And for me, as somebody that kind of takes this data from public domain and just talks about it, it sounds maybe I'm promotional about this company. So that's not the intent. I'm not trying to promote. I'm just trying to add value to the listener by covering the publicly available slides and just talking about those slides to better understand the value proposition from Suncor. Because clearly there is momentum and the stock is performing well. And obviously now that they produced 874,000 barrels per day in this one quarter, so on daily basis. I mean, one day this company is going to be 1 million barrels a day company, right? And that's a big chunk, right? That's 1% of world's oil demand in a sense. So that becomes a very important player, which it's a big legacy. And maybe the way I frame it is incorrect because it's already a very important player in the Canadian oil and gas space, but also it's a very important global company that produces significant amount of oil and refines and upgrades a lot of oil. So very important to consider. So let's talk a little bit about their debt maturity. And in the process, we can start kind of adding the numbers. So if we take the 2025-29 timeframe. So they have about 2.5 billion. And obviously with the free funds flow that they communicated, I think that number was, if we look previously, that number was 5.4, right? So getting 2.5 in debt between 2025 and 2029 is just not a problem. Like they could easily trickle and kind of manage that debt maturity profile. Then there is a little bit of a break, 2030 to 2034 timeframe. And that number is extremely important because, it kind of gives you understanding of the timelines here, right? And 2035 to 2039, we get 4 billion, I guess, and 3 billion post Q3 tender offer, and 2.8 in 2040 to 2051. So it kind of provides a little bit of a guideline towards when the debt matures. So debt maturity is not an issue, at all. Strong track record of cash returns. You can see Suncor, peer average, and cumulative. So you can see basically the cash returns profile from 2014 to 2023. And they basically say over 65% of average market cap return to shareholders over 10 years. And the cash yield, you can see basically, obviously, it was a very challenging environment between 2014 to 2020. So the return was just like under 5%. But now it's close to the 10% mark. So just under 10% from just based on kind of quickly calculating the data that was seen and trying to better understand the data. We see a 10% return here that Suncor communicates. They also tell us here that returning 100% to shareholders, disciplined capital allocation. So, and I've heard some gentlemen today on the news talked about that as well. And he was really alluding to this statement here, that they're returning at or near 100% of excess funds flow to shareholders via share buybacks. So if you look at the kind of production per share or free funds flow per share or return per share metric, you can see that the per share number is also declining. So that kind of, by definition, provides better performance. Achieved net debt target of 8 billion in Q3 2024. So, which basically suggests, and again, we talked about the maturity here, so of that 8 billion. And achieved net debt target of 8 billion in Q3 2024. And now that the market cap is about, I think in our original slides, it was like 62, 63 billion. Right now, as of today, 66 billion. So now with 8 here to 66, and we get about 74 billion. So if somebody was to buy them out today, I mean, obviously that's a lot of money. Maybe Nvidia could buy them out. I don't know, but you will get essentially 74 billion enterprise value. And if there's like a certain premium to those numbers that I provided initially, obviously, a big statement here when it comes to 874,000 barrels a day produced in Q4, 487,000 barrels throughput refined in Q4, and with upgrading capabilities and the gas station business and all that. So obviously significant amount of value, and the market is essentially pricing this company enterprise value at 74 billion. And obviously there could be a premium, I don't know, 10, 20%. So we're talking 85, 90 billion for all that, maybe if somebody buys them out. So, and the Canadian dollar makes it kind of easier that way. But this is not the conversation we're supposed to have about Suncor at all, because Suncor is a giant Canadian company that is very important on a global scale. So it most likely to be an acquirer versus getting acquired. So here they say that they committed to reliable growing dividend, targeting 3 to 5% annual growth. And obviously the share buyback statement here is very important as well. ensuring financial resilience, targeting one-time net debt to AFFO at $50 WTI US. Excess funds flow calculation. So the way they look at excess funds flow, and they basically told us that they return 100% of excess funds flow to share buybacks. But what does it mean? So they take the AFFO, so adjusted funds flow from operations, and they subtract the sustaining capital, so basically what requires to run the business. They embed the dividends in there and the economic capital, so anything kind of additional for growth. Plus, minus capital leases, working capital here, then you get excess funds available for share buybacks. That's the definition. So they talk about here, let's zoom out here. So they talk about integration and their Suncor integration. So you can see on this map, in Alberta, you have Fort Hills Mine. In Edmonton, you have this, I guess those are refineries. Syncrude, Base Plant, In Situ, that's the SAGD process I talked about. Commerce City here in US, logistic trading, retail, so gas stations, Montreal, East Coast, and Sarnia. So throughout all the sites, they basically, the upstream production, 790,000 barrels per day. We know this number is higher now, as communicated before. So you get oil sands mining, oil sands in situ, and East Coast offshore as well. Refining capacity, so 466,000. We know this number now is higher. Edmonton, Montreal, Sarnia, and Commerce City. And product sales through their Petro-Canada brand, 565,000 barrels per day. So to talk about no exploration risk, 7 billion barrels of 2P reserves. Reality is this is the truth. Like there is very little exploration risk when it comes to Suncor. The reason is simple. When it comes to mining, the mining, like it's literally you see like the mountain of basically bitumen, right? And oil sand bitumen. That's it's you don't kind of dig for it. You just kind of shovel it from surface and you refine it essentially. So very predictable production when it comes to their mining. They've been doing this for decades and decades. And when it comes to fireback, the asset is fully delineated, and there's a really good understanding of their geology, and Mackay as well. So they basically can just kind of template the recovery. And I would even say it's not even like the normal thinking about this type of business is not even oil and gas exploration. It's more of a manufacturing process. And you can see production mix in 2024 end. They have oil sands operations, so 0% mining decline and 12% in situ decline. E&P 15% decline, Syncrude 0% decline, Fort Hills 0% decline, so 5% corporate decline rate. The decline, reservoir risk, and recovery factor. So for mining, decline rate very low, reservoir risk low. Well, there's essentially no reservoir, and recovery factor high. Really a function of the equipment, how much you can refine, your refining capacity, and how many trucks you have basically to move the material to be refined. In situ, decline rate low, reservoir risk low, recovery factor low, and obviously fireback been doing extremely well for the last couple of quarters, especially. So yeah, looks good. Offshore, medium is defined, and tight oil, very high, and low. And I would say for tight oil, the decline rate risk is always very high because you have a type curve and the stuff produces a lot initially. I think that's main challenge also for US producers. Anybody that's using tight rock formation, especially in fracking, right? Obviously, fracking is the main method that used to produce those barrels. But reservoir risk is high. Maybe you have some geology that's challenging, and recovery factor is relatively low. Where firebag recovery factor could go to 70-80% easily. Integrated footprint of oil sands. You can see the map here of Base Plant, Firebag, Syncrude, Fort Hills, Mackay River, Edmonton Refinery, the mining activities that I talked about in situ and pipeline, and all of those are kind of integrated on this map. The slide says that the strategy maximize margin and keep upgraders full, so above 90% of utilization. Optionality for multiple oil sands assets, so mining and in situ, and oil sands are connected by pipeline. Fireback, Mackay River, so those are basically connected to base plant. Syncrude base plant and Fort Hills connected to base plant. Close proximity of significant assets, optimize consolidate storage, warehouse, and supply chain management, consolidation of regional contracts. 900,000 barrels per day mining operations, 700,000 barrels per day net. So there are some partnerships, and 700,000 barrels per day upgrading operations, 500,000 barrels per day net. And you can see kind of on the little map here where those operations are located. Upstream oil sands operation. So for me, kind of this was a big one for this quarter. Was not just this quarter, this year. Fireback performed extremely well, but let's kind of look into more details. Upgrading and mining assets. So in 2019 to 2023, base plant upgrade utilization constantly 90%. Syncrude utilization has steadily improved with record production in 2023. And Fort Hills 3-year mine improvement plan 2023 to 2025 on target. And you can kind of see the various percent of the nameplate for the various assets, base plant, Syncrude, and Fort Hills. And obviously there was a pandemic, right? So COVID curtailment, and you can see basically Fort Hills was the asset that kind of produced, was not utilized as much, I guess. For the in situ assets that we see here, combined average of 90% utilization over the past 10 years with path to 95%, and increased production capacity by 20% through the debottlenecking. So you can see the production here, and 210,000 barrels per day capacity, and obviously production is continuing to increase for in situ assets. Upstream oil sands operation looks good on this slide. So downstream business in the industry. Here's a winning formula I guess they suggest. You can see billions in Canadian dollars on the right, benchmark cracks in US dollars per barrel. And you can see kind of the various fluctuations over time. Obviously, big swing from 2020 going to roughly $20, and then 2022 peaks at about 45, and you get that 50% average incremental margin in 5-to-1 versus 3-to-1 crack spreads. Low-cost crude feedstock versus WTI due to proximity of upstream production. Facilities tailored for higher diesel production, so 2-1-1 and 3-to-1. And access to strong product markets. Industry-leading retail and wholesale business enhancing 5-to-1. So obviously a little bit technical here on the various kind of crack spreads, I guess. But you can see that the company is not just relying on its upstream operations. It's basically providing the entire integration of basically the oil supply, refining, and to sales, right? So you have all of those businesses are kind of integrated within Suncor. Here's a slide that talks about industry-leading refinery utilization and profitability. So you can see here refining EBITDA. So they use pure average, and then for operational execution, Suncor US average and Canadian average, the average annual utilization. So they're trying to be at kind of the higher performance on that metric. So let's talk about capital budget. I like the slide because it kind of talks a little bit how the money is being allocated. And before we talked about market cap 66 billion as of today, about 8 billion in debt. So enterprise value is about 74. Maybe it's below now, right? So we Q4, they're going to be reporting Q4. So looking forward to seeing where the debt level is at. But let's kind of go over like where some of the money is being allocated. So economic investment capital, investing in projects to improve efficiency, flexibility, and resilience. So you have exploration and production, 700 million. In situ well pads, 350 to 370 million. And other economic investments, I guess, is 1.8 to 1.9 or so billion. So you get close to $3 billion, $2.9 billion in those kind of investments. And project examples include West White Rose and Sea Rose, Fireback and Mackay River well pads, and Mildred Lake Extension U1 drum replacement, Fort Hills haul truck cogeneration. So you see lots of kind of engineering activities to optimize the assets. Asset sustainment and maintenance, you basically have as much money. So on the capital, a little bit more, 3.4 to 3.5 billion. And to sustain those assets, you see on oil sands side, they're basically spending 2.3 to 2.4. And that's again for 2024 capital budget. So for 2025, the numbers will be, I guess, in that range. But I think it's important kind of to be mindful of whether they're kind of increasing above that 6.5. I don't think they are, but I think it's kind of somebody needs to be mindful of whether those numbers increasing significantly or not. Downstream, so about $1 billion, and the corporate 75 million, I guess. So in overall, the total for capital budget is about 6.3 to 6.5 billion, and they're going to report the Q4. And obviously, we already know that they have really great news when it comes to kind of capital spend, when it comes to their refining, the operational activities, the oil production. So we know a lot of these projects are already kind of delivering results in a way. So for 2024 capital production guidance, and now we're going to compare it to 2025 capital budget. So I think it's important. Oh yeah, so like I was saying, we looked at 2024. I find it kind of funny why they put those slides kind of in that order, but I guess they have a theme for 2024, and then they have a theme for 2025. So let's just quickly compare that. This number here, 700, 350, 1.8, so 2.9, 2.965. So very similar, slightly less, very similar projects. And for oil sands downstream corporate, it's about 3.4, 3.5 for 2025. And it's very similar number here. So we get 6.3 to 6.5 range, and they're going to spend a little bit less in 2025. So for 2024, like when we look at the operations, and they also provided some guidance, I guess, that now we know they basically outperformed. Oil sands operation clearly outperformed, right? So Firebag is doing extremely well. Fort Hills is doing well. Syncro is doing well. And so total upstream production, obviously Q4, they reported 874,000 barrels a day. And here they provided this range of 810, 770, 810. Refining throughput, obviously 430 to 445. So we know this number is now higher. That refinery throughput was 487. And here they basically provide different sensitivities to their activities. So for example, if $1 in Brent moves by $1, that makes an impact of 200 million, I guess, 200,000 on adjusted funds flow operations. That M is a little bit confusing to me. No, it can be, it has to be million. Yeah, so, and here you can see like the relative loss, I guess, on the FX, on the exchange, if US to Canadian dollar, and obviously it's been a big story, right? So 0.01, it plays a very important role if it moves by US dollar appreciates, right? So this is something to be kind of mindful of on the sensitivity side. Something I'm going to have to investigate a little bit further. And if $1 moves on WCS differentials, you get $10 million impact. Obviously, it's not 10,000; it can be 1,000. So $10 million impact. So a lot of moving parts here, obviously, right? So, but it's a good integrated company and they provide some sensitivities here. I think that's kind of like the cost of supply is really important because if you look at our cash operating cost, dollars per barrel, you basically have like, what is this average 28 to 31? That's about $30 per barrel. And Fort Hills is about 35 and Syncrude is like $36. And sorry if you guys hear screaming, it's my kid playing games, screaming in the background. Um, so so yeah, it's kind of a lower cost of supply producer, which is great. And obviously for 2025 capital expenditure, we're looking at kind of similar metrics. Here they share 2629. So 2629 and here 2831. So lower cost of supply. And 3336 and here we get 3336. So also lower cost of supply production in 2025. Now the guidance obviously changed here. So 880 to 920. So big difference in production guidance relatively to 2024. So here it was 770 to 810. So huge difference. And again, we get some sensitivities here that I'm going to have to kind of investigate a little bit further. But we get essentially the FX. I think it's one of the more important elements here because 0.01 FX US to Canadian dollar movement makes a big difference. And I think this is one of the more untold stories in last year was basically the FX. Because now in Canadian dollars, WTI trades at like over $100 per barrel. And so 2025 capital budget, as mentioned before, we get for the economic investments. So it's close to 2.6 to 2.7 billion dollars, and for the sustainment and maintenance, we get about 3.4 to 3.5. So essentially, we get 6 to 6.3, 6.1 to 6.3 capital budget for this company. So if we think about this, they produce the enterprise value 74 billion. They spend about 6.3 billion in 2025 on their activities, and they generate. If we look in here, and obviously this year is going to be much better if production like Q4 continues. So free funds flow 5.4. It's probably Q4. We didn't add Q4 here, so we're going to go by let's say another 2, so 7.4 or so, and 10% free cash flow yield, basically something like that, which is kind of consistent with this graph here, where this could go maybe higher here, like that, maybe something like this, 10%. All right. So let's see what they have here in the appendix. So mining, upgrading, base, Millennium, and North, Steep Bank. Bitumen production 250,000. Suncor working interest 100%. And then we have Syncrude, Mildred Lake, Aurora North. We get bitumen production for 2023 was 212,000 barrels per day. And working interest is 5874. Suncor operated. And significant resource here as well, 994 million and 2P reserves. Fort Hills, 223 bitumen production at 147,000 barrels per day, working interest 100%. And again, significant reserves, but close to 2 billion barrels of 2P reserves. In Firebag, 2.7 billion barrels in 2P reserves. 2023 production 217,000, but now we know it's over 250,000, maybe a little bit less this month, but looks pretty good. And then the other SAGD asset, it's called Mackay River. So 34,000, I think it's closer to 40 right now, but don't take my word for it. So working interest 100% and 464 million barrels in 2P reserves. This is their offshore with 250 million barrels of 2P reserves. Obviously, core operations, they're all here in what was specified here. But then they have this Hibernia, so very small number, 14,000 barrels per day. Hebron, 25,000. White Rose, 5,000. And Terra Nova, Suncor operated, working interest. Yeah, I don't know if they actually operate that, so something to kind of more investigate. Refining advantage, so Edmonton, 146,000 barrels per day. Here they tell us basically what kind of products they create there. Feedstock advantages directly connected to oil sands production, ability to process multiple crude types. So then they produce diluted bitumen, 21%, 29 sour, 39 sweet, and 11 others. And the product advantages, they get 42% gasoline, 53% distillate, and 5% other. In Montreal, they have 137,000 barrels per day refining. Commerce City, 98,000. So that's US refining. Another fascinating story, right? Like what's going to happen to with Trump in power? What's going to happen to kind of US refining capacity being essentially ran, owned, and operated by Canadian firms? So here they say supplies third of jet fuel used at Denver International Airport via direct pipeline, Colorado's largest producer and supplier of paving grade asphalt. So what's the plan here, right? Like those are the type of questions I have. So now if Canadian companies, because of the tariffs, don't operate some of those assets, Suncor literally supplies third of jet fuel that used at Denver's International Airport and Colorado's largest producing supplier of paving grade asphalt. Like, do we have an alternative to that product? And bulk of crude from Colorado and local basins, resulting in transportation and pricing advantages, optionality for North Dakota, Wyoming, Montana, Western Canadian crude. And they basically supply 13% diluted bitumen, 20% sour, 65% sweet, and 2% others. And here we can see a map of how everything is basically all the products are being integrated. Well, I think it's kind of, just kind of let's summarize this map and then maybe concluded that most operations are here. 555,000 product sales in 2023, 20% Canadian consumer fuel market, 325 wholesale card lock locations, 1,585 Petro-Canada retail sites, and 50% North American retail sites Suncor owned. And here we have basically refinery, cogeneration. Those are the mining operations here and in situ upgrading, so Mackay and Firebag. And export capability to US West Coast and Asia. And the Commerce City is only refinery in Colorado and largest refinery in the US Rockies. So, yeah, an important company. Thank you so much for listening to me. Like, subscribe, I guess, to the YouTube channel for more updates on other companies. Let me know in comments what you think about Suncor. this was a quick study to kind of overview the company and to better understand what they're up to. All the best. Thank you.